Oh yeah, you okay?
Yes, I'm all right. Okay. Sorry, I think the thing was getting updated or something. It took a long time.
That's okay.
Yeah, but now it's all right under control, I think. Yes. Right. Okay. So how is your new year getting on?
Yeah, I'm just listening to your last two lectures today,
Okay.
and obviously, I tried to go through the past cards, but
Mm-hmm.
really, yeah, I may find it more confusing, to be honest. It's easier
Mm-hmm.
if I go through slides because it's, there is maybe too much information or too much detail into that, I at this stage I don't know if I'm not unsure. Uh, but this,
Yeah.
I think started losing the track of whatever the concepts that were in my head unless
Mm-hmm.
I go through with past cards, which I don't think that we have the time for. Um,
Yeah.
I'm not sure if because if it's 5-10 pages, it's different. It's about 50 pages for just consolidation in past
Yeah,
cards. So
because
it's
consolidation is a big area. So
mm,
it's a big area. So we will try as much as possible. Uh,
mm,
but it's a risk because if they put up on F2, it will be all on consolidation. But anyway, as
mm,
we are proceeding with it, so what we saw last time, you can acquire a subsidiary. Acquiring a subsidiary means you take more than 50%. You can do it in
mm,
one shot or you can do it in installments, what we call piecemeal.
mm,
So what we said was, okay, if you take a kind of a 20% interest just now, and in another 6 months time you take another 35%, you become the parent and the other company becomes subsidiary only when you take the next 35% because you had the 55%
mm,
or the 50%. So the goodwill
mm,
arises only when you have a control. So the initial
mm,
20% no goodwill. It's just an
mm,
associate company investment, no goodwill. The goodwill
mm,
arises only when you take the entire control. When I mean by
mm,
entire control, you have to have more than 50% control.
mm,
So that is what we call a piecemeal acquisition. So at that time, we will calculate the goodwill. How do we calculate? We look at the amount what we pay for the 35%, the second installment. And also we look at the fair value of that first 20% as at the day of the control, compare that with the net assets, our share, and that's how we calculate the goodwill.
mm.
Right? So that is what we need to know basically very fundamentally on a piecemeal acquisition, because generally most of our case study questions will be on a piecemeal acquisition.
Yep.
Or it can be the other way about, we want to look at a piecemeal disposal. This is very important. Piecemeal disposal. So for example, you company A is holding in company B 80% interest today. Or at the beginning of this January, you have 80% control, so you are a parent.
Mm,
She is a subsidiary, and
mm,
therefore parent must consolidate the subsidiary and prepare consolidated financial statement. So
mm,
this was as at say, let's assume 1st January 17.
mm,
Maybe at a particular point, maybe on the 31st March, you might decide to sell 25% of this control.
mm,
So then what happens is still you have 55%.
mm.
Still it's a
Everything
subsidiary.
everything remains the same. Yes, still
Every,
consolidation.
yeah, everything remains same because it's still a subsidiary.
Yep.
And therefore, the goodwill what you worked out at this point, at the beginning, or when you acquired the goodwill, that goodwill will remain even with 55%.
Yep.
No change. What is happening here is your non-controlling interest, which was 20% originally,
I've
has
gone
now
up to
gone up to
45%.
45%. Have gone up to 45%. So there is a change in the non-controlling interest. You got some money. You got some money by selling that 25%. You have to compare that money what you got with the additional non-controlling interest power they have got. So for example, the consideration you got maybe 200,000, but the non-controlling interest additional that from 20 to 45%, the 25%, their additional controlling interest may be worth 150,000. So you are sacrificing 150,000 worth of rights for a payment of 200,000. Or you get a payment or you get a receipt of 200,000, and for that you are sacrificing to non-controlling interest 150,000. So what do we have? Do you have a profit or a loss situation here? You got 200 and you sacrifice something worth 150,000.
Still a profit.
It's a profit. So that profit will be reflected in the parent company books, in the consolidated financial statements as other equity. Other equity. Because even though it's a profit, it's not realized profit because it's just a it's not a realized profit. It's a book entry, and therefore it is considered as other comprehensive income and reflected in other equity. That profit of 50,000. So the goodwill remains same unless there's an impairment. What is happening is the non-controlling interest is changing. That change is a sacrifice you are making, and for that you are getting some money. That money, if it is more than the sacrifice, it's a profit, and that profit will be reflected as other equity because it is not realized profit yet. Right? So that is one scenario you can have it. Second scenario, you might come down from 80% to 40%. You sell 40% of your original interest. Now, at this stage, B is not a subsidiary. B is not a subsidiary because you don't have 50% interest, so it's not a subsidiary. What is it? What is B now? Associate company. You will have significant interest, but surely not the entire thing. So at this point, you have to consider that you have sold the subsidiary. Sold the subsidiary. So when
IS 20, wasn't it?
IS 28 is the associate company, but now it's not a problem of associate company. It becomes an associate company, but you have sold the subsidiary. So when you sell the subsidiary, you sell the goodwill, you sell all the assets, and what do you get? You get money, and you get the fair value of this 40% as consideration. The fair value of the market value of the 40% what you are holding plus the money what you get is what you get, and what you have sold is the subsidiary. So you sell your goodwill, you sell the assets of that company. You are not going to after that consolidate it any longer. As you rightly said, it will be IS 28 associate company accounting, and this is completely sold. At that
so
point,
there is no control, no rights.
No control, no non-controlling interest, no consolidation. It's gone. It's a complete disposal. the money
That's
what the consideration what you get is the money for the 40%, and also the money for the 40% what you sold, and the 40% what you are holding, the fair value is the total consideration.
Yep.
Against that, you compare what you have disposed, the goodwill and the net assets of that company. If you have got 300,000 and if the value of what you have disposed is 250, there's a 50,000 profit. That 50,000 profit is not other equity. That 50,000 profit is trade profit. That will go to the P&L because it's a realized profit because you have disposed the subsidiary.
Sorry, say that. Say I lost you there. Just go back 1 minute, please.
Yeah, what I said was the moment you earlier I said when it's still a subsidiary, when you dispose, what you have disposed is not a subsidiary. So therefore, the profit what you have earned is a unrealized profit, and it is shown under other equity.
Yeah, because it's within the company. It's not really you haven't.
Yeah, but the second scenario, the second scenario, you are completely disposed the subsidiary. You are no longer controlling. So because of that, the subsidiary is disposed. So the money what you get is the 40% for the money what you get, and the 40% the value of the balance that is there is your total consideration. Against that you are disposed your goodwill. Against that you are disposed the net assets of that company. And if you make a profit, that is when you sell the subsidiary, if you make a profit, that profit is reflected in the profit and loss statement, not in other equity.
Okay.
Right? Not in other equity. So the moment you become a non-subsidiary or the parent becomes no longer a subsidiary in that other company, then it's a complete disposal. Profit or loss arising will be treated as part of the P&L. Now another scenario, maybe you completely dispose it. Entire thing is disposed. So no more associate, no more subsidiary. The entire thing is disposed, and that disposal, the entire profit will be considered to the P&L. So in the first scenario, what has happened is, say halfway through the year, if you have sold the business 25%, still it's a subsidiary, but your profit distribution, first 3 months, you had 20% non-controlling. Second 9 months, you had 45% non-controlling. So you have to portion the profit accordingly, according to the time basis.
Yeah.
Second scenario, where you have completely disposed the subsidiary, I mean 40% disposed. So at that point, what will happen is it becomes an associate company. So up to that point, up to the point of sale, you will consolidate the first 3 months. After that, the 9 months, you will consider it as an associate company. No more consolidation.
Yep.
Third scenario, the moment you dispose, no associate, no subsidiary, completely dispose, take the profit, and that's the end of it. So these are the possible three scenarios. This is what we call disposal, piecemeal disposal. Earlier we were talking about piecemeal acquisition. Here just
second and third scenario are disposal. But even the first scenario where you're still the parent and you still have a subsidiary, are you still called a disposal because you haven't really lost the?
It's not a disposal. It's a transfer of control, non-controlling from 20 to 45%.
So it's not a disposal, is it?
Not considered as a disposal.
Yeah, that's fine. Yeah.
It's not considered as, and that is why there is a profit arising. That profit is not considered as a P&L item. It is considered as other equity item. But the second, the third and the fourth scenario, it's a complete disposal, one a complete disposal, the other one a partial disposal. But in both the cases, you are no longer the parent. In that case, the entire profit or loss will be reflected as profit or the loss. So that's how the accounting treatment will come out.
Yep.
So those are the few things what we need to learn about the disposal and acquisition on installment basis. Right. Then another little thing before I move into the mock is all about the consolidation, the non-controlling interest. You remember I told you that when we acquire 50% or 55%, the balance is held by some outsiders and we call them non-controlling interest. Right? And you remember I told you the value of a company's net assets, of the subsidiary value is net assets. Well, what is net assets? Share capital plus earnings plus any other reserves.
Yes.
See the real value of that subsidiary. So let's assume the share capital is 100,000. Retained earnings 50,000. And other reserves, let's assume 30,000. The total net assets of this company is 180,000. Let's assume that today, on 1st April 2017, you are taking for 60% control of this company. Control of this company. So one way to value the non-controlling interest on this day is to take 60%. 60% is our control, 40% is the non-controlling. 72,000 will be the value of non-controlling interest today, the day that you acquire 60%. This method is called proportion method.
What are we doing here? We are calculating the
we calculated the non-controlling interest very simply because we are taking a 60%, 40% are outsiders. So we know on the day of acquisition, the net assets are 180,000. 40% of is the outsiders.
So this is the calculation method to is the method to calculate the non-controlling
interest. One method of calculation of non-controlling interest. One method. So now this is on today, 1st April, 1st January 2017. Let's assume this company, after we acquire 50,000 was the retained earnings, after acquiring the company, say end of December 2017, retained earnings have gone up to 80,000. Right. So how come the retained earnings go up from 50 to 80?
Make profit.
Yeah, the profit. That is after acquisition, the company has made a profit. So this is what we call pre-acquisition profit.
Yes.
After acquisition, the company has made the retained earnings are 80. That means there's a 30,000. What we call post-acquisition profit. From 50, the retained earnings have gone up to 80. That is after acquisition, 30,000 post-acquisition profit. So if you are preparing the consolidated balance sheet on 31st December 2017, the non-controlling interest figure will be the original figure of 72,000. And when the company makes a 30,000 profit, 40% of that 30,000 belongs to these people.
Yes. Another 12.
The non-controlling interest on 31st December 2017 is 84,000. At the beginning it was 72. With the post-acquisition profit of 30,000, 40% of that belongs to them, 84,000. For the parent company, only the post-acquisition profits we take it. So the company has made 30,000 profit. 60% of that is post-acquisition to the parent. That will go to the consolidated P&L, and this is what we call post-acquisition profit. Right. So this is one way to calculate the non-controlling interest on the day of acquisition and to say the non-controlling interest on the day of reporting. Reporting day is the day that you prepare your balance sheet or the statement of financial positions. So you look at the opening retained earnings at the day of acquisition, and then you look at the closing retained earnings. The difference is the post-acquisition profits, and of that post-acquisition profit, for whatever the non-controlling interest percentage goes to them, whatever the other percentage goes to these people. Okay. So that is one little thing we need to learn to calculate the non-controlling interest. I told you 100, 180 is the net assets of that company. Now sometimes without giving the proportion method, the examiner might say non-controlling interest is valued at fair value method. In that case, the examiner will tell you the fair value. Now, if it is 40%, you know it is 72. But without valuing at 72, they might say the fair value of non-controlling interest is 80,000, for example, 90,000. Examiner will tell you without applying the proportion. In that case, you will take the entire 90,000, which the examiner says is the fair value of NCI.
Sorry, I didn't get that bit.
The examiner will tell you without saying because there are two methods to calculate the non-controlling interest. One is the proportion method, the other one is the fair value method. So proportion method, if the examiner says we take the proportion, 180, 40% we take. But without saying the proportion method, examiner might say non-controlling interest is valued at fair value method. In that case, the examiner might give you the non-controlling interest fair value as 90, for example. Say 85. 85 is non-controlling interest on the day of the valuation, on the acquisition. So in that case, what we will look at is we will look at the consideration what we have to pay, right? So because now we are taking, let's assume we are taking 60% interest. 60% interest, we may pay, let's assume we are going to pay 130,000 consideration. And also we have a non-controlling interest of 85,000. So altogether we paid 130 to get that 60%, but we are assuming a kind of a liability or kind of an obligation or kind of a outside interest where we have to service them, we have to care for them, and that is 215. That is the value the examiner says, 215. What's the total value of the company? 180. So we don't apply the proportion. We take the 180 and then we say 215 is the total consideration plus the NCI. The value of the company 180. What's the difference? What is this difference? We are paying more. We are paying more. Or rather, we pay 130, but we are taking responsibility for 85. So 215, the company's worth is 180. Why are we paying that 35 more?
Is that a goodwill?
That's a goodwill. That's another way to calculate the goodwill and another way to calculate the NCI. Now, if the...
You know what, I didn't understand. I understood there's a goodwill, but I didn't understand this fair value method. I've read that already. I've studied that years ago, so it does,
Yeah, the fair value means
the
examiner says without v-valuing the goodwill, without v-valuing the NCI on a proportion method, examiner says the value of the goodwill is so much. The value of the NCI is so much. If the examiner is not told, the consideration is 130. The proportion of NCI is 180, 40%, 72. 202, right? 130 plus 72, 202. The total value of the company is 180. Goodwill is 22. So now you can see the two methods how the goodwill can be different. Same calculation I did. Consideration plus the NCI, but in the first, on the left hand side calculation, I took the NCI on proportion. But here, I took the NCI that is given as the fair value, the total value. Fair value. So without we apply the proportion, we apply the total value and then do it. So these are the few differences what we need to know. So these are some other things which I can just pick it up, but later on we will see with other questions whether we get something more. But for the moment, let it be all right with these things.
Yes.
As you go along, maybe in other marks we might get something better. So let's go into the mock now again. So remember, we were on that problem film, the summer night, where we hired an actor, and that fellow was having some problems, and there were litigation, all that, and ultimately what happened is we decided to suspend the film, and because we want to go for some new people, and then the employees, the production team protested, saying that they are losing their early completion bonus, and we just agreed that we pay something nominal, but not a bonus, because we don't want to create a precedence. That was the second section of that mock. So today we are on to the third section of that mock, and 6 months have passed since the TV documentary on our film Summer Night was broadcast. So far, we have not been successful in finding a replacement for Stan, as all top stars are fully booked for 2017. This can always happen because once the actor is assigned, he will not take another film because he's completely booked for that particular film. So our competitors have gone to great lengths to ensure that viewers remember the documentary that caused the problem by publishing advertisement and mentioning it in the press articles, refer sample advertisement. So this is always because you have really gone down, you hired the wrong actor, and he was up to mischief, and now the film is suspended, and the competitors who are putting up other films is really attacking you in different ways. Society is very sensitive, so they keep reminding the society, look here what Maintain did. Maintain hired notoriously wrong character, and look here what Maintain did. So this is what they have been doing. There have been also continuing press reports concerning Stan, who is taking legal action against Maintain for the breach of contract, and adverse publicity continues. So you can imagine in a situation like this, your film is not happening, right? Film is not happening. Your main actor was up to mischief, and now he is filing action because you have terminated the contract. And remember, your lawyer said probably he will have a claim against you. And the competitors are really attacking you, exploiting this your position, and making very public statements about the whole thing. So your CEO is really getting frustrated, and he is writing to you, I'm getting tired and fed up with continuing negative publicity from this documentary, especially since we have not yet been able to find a replacement actor for Stan, although 6 months have lapsed. As you are aware, Summer Night Finance Limited, 60% equity is owned by Maintain and the balance by LOLC. So, you remember always this financing was done major shares by us, and a third party was taking the other part. So there's a company called Summer Night Finance for this film. 60% our funding, 40% the other company funding. So because the other company is 40%, we have to prepare Maintain will have to consolidate the subsidiary and show that as an uncontrolling interest. Right? So, Maintain distributors could, as you're aware, Summer Night Finance, and one possibility that has been put forward is that we should sell 50% of our equity on this film to LOLC, just retaining 10% of the equity. Now, what happens when they sell 50%?
They become, it just becomes an investor. You just
become an investor. Yeah, because we have only 10% investment, 90% is with the LOLC. So in that case, one night, Summer Night will not be a subsidiary any longer.
It will piecemeal disposal, and it will be coming on appearing on accounts as other equity. Yeah.
Right? No, it will be a complete disposal. Because the moment, the moment you take you dispose 50%, you are no longer the parent.
The first one was piecemeal. The second one, third one complete. So it will be a complete disposal. Yeah. It will appear account on the books as other equity because you only have 10%.
No, not yeah, that's right. It will be not it will appear as other investment. It will appear as investment, but the profit or loss arising will be a complete profit or loss, realized profit or loss arising, which will go to the P&L of Maintain. No longer after this you will consolidate the Summer Night Finance in Maintain financial statements. Because you don't have any more power to control the company the moment you dispose 90%. At the moment, it's a subsidiary. At the moment, Maintain Finance is a subsidiary with a 60%, 40% owned by non-controlling. Right? So, Maintain Distribution could bid with any other distributing company to distribute the film, and Summer Night Production can continue to produce the film. Right? So what they are going to do is they are going to completely dispose this ownership of this company, but they will produce the film. You remember every film they have a financing company and they have a production company. Production company is fully owned by the Mentine.
Mm.
So Mentine will produce the film, right? Mentine will produce the film, but they are no longer the owners.
Mm-hmm.
And you remember there's another company called Mentine Distributors who distribute their films like any other company's films. So Mentine Distributors also will bid for this film when it comes for distribution along with other competitors.
Mm.
So whoever bids the highest, the new owners will be LOLC. We have only a 10% interest. They will give it to us or to other party, whoever who has bid.
Mm.
Right? So you have to understand the scenario what is happening here. Earlier we were the major owners. We can decide we are going to distribute the film. Now we can't decide like that because we are not the major owners.
Mm.
Some others are owning. But we will produce the film for them and they will decide to distribute it through us or they can distribute it through any other company. We don't have control over that decision.
Mm.
Right? So we will be able to claim that Summer Night is indeed is owned by LOLC. So this man is really getting tired of the whole thing. What he says is this is not our child, this is somebody else's child, and so the shareholders don't need to get worried because whether it's a loss or a profit, it does not matter. We only have a 10% interest in the company.
Mm.
By selling, we might make a profit. Selling, we might make a loss. It's a different story. But we will not depend on the film outcome for our profit or loss. This is what he wants to do.
Mm.
Please email your thoughts on the following. What impacts will the disposal of finance subsidiary will have on Mentine's consolidated financial statements? We don't require calculations at this moment, but we do need to know what will happen to the accounts. How can we value shares of Essent Finance to negotiate the consideration that need to be paid by LOLC for our 50% stake? How can we tell whether the net effect of divesting the subsidiary will be able to enhance future cash flow? So there are 1, 2, 3, 4 tasks in this question.
Mm.
So the advertisement that is put by our competitors is best films do not employ immoral cast. We films where moral people are chosen for the cast. The direct attack on our company, right?
Mm.
Direct attack on our company, and people are being completely reminded all the time, reminded the Mentine did a blunder and Mentine film should not be viewed, they are not the best films. So this kind of continuous advertisements will put your morale down, will put the share prices down, will put the company down. So CEO is thinking, might as well sell this film, forget about it, right? We will produce, but we will sell it so that we can tell we are no longer the owners of the film. So it does not matter whether the film is a success or not. It's not going to make a big impact because we only hold 10%.
Mm.
So this is what the scenario is.
The real life situation,
Hmm?
you know, in
Yeah.
the real life situation, well, it's going to be hard to find a buyer, or if you want to buy it to the subsidiary, sell it to the company which is the company which is holding 40% shares.
Yeah.
So it would be hard to realistic would have to get a decent money because they know about the cost and everything.
Yeah.
But
because it all depends, because sometimes it may go at a very bargain, because otherwise those fellows lose their 40% also.
Okay.
Yeah. So they will lose their 40% also if nothing is done by Mentine. So you might as well take control of the thing and do something about it.
So tell them, you either buy it from us and do it properly.
Yeah.
Because we might not distribute or produce the movie from now on, and we all lose the money.
Yeah, because now already your 40% is there. So you might as well take control, because the Mentine is not going to do. Mentine has not been able to find the actor for 6 months, going through crisis. You take the total control of the film and you try to do it. This can happen in real life in many ways, real life. Because I have put my 40%, you Mentine is not doing anything about the film, 6 months have gone, my money is just idling in your company. I might as well put another 50%, take the whole thing, good film. It's only a problem of not finding the right cast, and do the film. Maybe I will not give it to Mentine for distribution, I'll give it to some others for distribution. Completely get the Mentine out of the mentality, and go through the film.
I see now. I understand now. Yeah.
It's not like an outsider coming, because I already have a 40% claim. If I don't do anything, I will lose my 40%. Might as well put another 50% and make a 90% and make a big decision, and I can go and do it anywhere. This is what I want to do it in this kind of a scenario.
Yep.
Maintain's name is down, not the LOLC name. So the LOLC will come and say, here we are making the film now, and they might be able to better negotiate with the cast, do it, distribute the film either through Mentine, if the Mentine distributor is good, or they can do it with any other distributor. Mentine's interest will be only 10%. So Mentine, if they make a profit, they will get some dividend. If they don't make a profit, bad luck, they will write off the 10%. That's all. But when they sell, what you said might happen, the LOSC may be at an advantage, they can buy it, the shares, the 50% at a cheaper rate. When the company is not doing well. So they may be able to buy the shares at a bargain rate. And after buying it at the bargain rate, if they can sign a number one actor, what will be the outcome of the film?
Could be a hit film.
Yeah. You remember that there were some superstars in that precinct. You get one of those fellows signed, and the film can be a hit.
Yep.
So these things do happen in these organizations. Something that I can't manage, some other person can take it and manage it, do it better than what I did, and it may be a top hit. I was speaking to one of my friends who was running a company. He sold this company some years back because he could not run it. But today this company is one of the top 10 in Sri Lanka.
Wow.
Yeah. That other man who bought it, he did certain changes. He had the government influence, this, that, and the other. He managed to put it on top 10. So these things do happen. These things can happen. So this is real life in business. What is not good for me can be good for you.
Exactly. Yeah. Same with the woman, I think.
Exactly. That's why the people are having all the exchanges and the changes and the selling. Only thing, unfortunately, it won't happen in the open market. It happens in a different market. Right. So, what impacts will the disposal finance subsidiary will have on Menti's consolidated financials? So, remember here there are 4 tasks. So, again our 45 minutes, 15 minutes for reading, 5 minutes for wrapping up, 20 minutes gone. The balance 25 minutes in this case, I'm going to split it for 4 tasks. So, maybe 6 minutes, 6 minutes, 6 minutes, 6 minutes each. Yep. I can't do a 13 and a 12 here. So I must be very careful because I have 4 tasks to address. So I will take 6, 6, 6, something like that.
Yeah.
So your paragraphs will be shorter. Your sentences will be shorter. The last examiner's report, examiner has been talking about saying don't expect marks for quantity. Marks are given for quality. So it can be a short report, but with quality you might get marks. So don't rewrite the question back to the examiner and all that. It's not going to help. Okay, so what impacts will the disposal of subsidiary will have on maintains consolidated financial statement? So what happens is this, because 90% is now owned by LOLC, the SN Finance will not be a subsidiary from the day of that disposal.
Because 90% owned by LOLC.
Because 90% is owned by LOLC, from the day that LOLC takes that 50% balance, already they have 40. From the day that LOLC take the 50% balance, SN Finance will not be a subsidiary of Maintain.
SN Finance is the SN is the Maintain one, yeah.
SN Finance is the company, the present company owning the film company. So it will not, it is right at the moment it's a subsidiary of Maintain with the 60%, but the moment they sell it, the 90, it will not be a subsidiary.
SN Finance is the parent company.
Pardon?
SN Finance will not.
No, Maintain is the parent company. Maintain is the parent company. Maintain owns
SN Finance will no longer be the subsidiary, yeah.
Yeah, SN Finance will not be a subsidiary of Maintain from that day.
Yeah.
From that day.
Right. So that's the impact, yeah.
Yeah. So up to that date, SN subsidiary will be consolidated. And on that day, the consideration what they received for the 50%
will be consolidated.
Yeah.
Sorry, I'm just trying to write some notes, so I want to.
Yeah.
Carry on.
Yeah.
Yeah.
On the day, the consideration received for the 50%.
Consolidation receipt.
Consideration. The money received.
Yeah. Consideration. Receipt.
Yeah.
Received.
Yeah. Because they are going to get money when they sell 50% of the share. They are going to get money. Plus the fair value of the 10%.
Sorry, I lost you. Another day consolidation received will be?
Consideration for the 50% received plus the fair value of 10% we retain.
Yep.
Will be offset against the group share of the subsidiaries assets. Against the group share of the subsidiaries assets. Because now we are selling the entire assets. Plus the goodwill. Will be calculated. And any profit or loss arising will be treated as a profit or loss on disposal of subsidiary.
Profit or loss?
Or profit or loss on disposal of subsidiary. Subsidiary. Profit or loss on disposal of subsidiary. As it's a complete disposal.
Okay. So I'll read that back to you. Because 90% is now owned by LLC from the day LLC takes the 50% balance. Finance will no longer be the subsidiary of Mentine.
Yeah.
Up to that date, SN Finance will be consolidated as usual. On the day, consideration received for the 50%, consideration will be received 50%, plus the fair value of 50%. Will retain. Plus the fair value of 10% will retain. Will be offset. Against group share of the subsidiary assets. Plus the goodwill. Okay. Plus the goodwill will be calculated, and any profit or loss arising will be treated as a profit or loss on disposal of subsidiary. As a complete disposal. Okay.
Exactly.
You were trying to tell the examiner that we are aware of the whole consolidation and the whole disposal.
That is what he is asking. He's asking what impacts will be the disposal. So the impact is the moment the other party takes 90%, it's no longer subsidiary. So it will go off the consolidation.
Not subsidiary. Number 2.
Up to the date it is a subsidiary and it will be consolidated.
That's the first thing you say, yeah?
Yeah. Up to the date of disposal, it will be a subsidiary and it will be consolidated.
Yeah, and then you start saying.
And after that, it will be disposed. No more consolidation.
It will lose its subsidiary and it goes off the.
It goes off consolidation process.
It goes off consolidation process.
And the balance 10% will be shown as a normal investment.
Rest of the balance. Yeah, as normal investment.
Yeah.
Just preparing myself with any other questions.
That's yes, because this won't be the question.
Number 1, you say that it's going to be until the day of disposal. It will be just a normal process. It will be consolidated until the day.
Yeah, correct.
From the day it's disposed, on the day of disposal. It's no longer the subsidiary. It goes off the consolidation process.
Correct.
To the rest of the balance. So if the company still has, in a situation, it might have a complete disposal. Or it might be keeping 10%, like in this present situation. Then say that the rest of the money will be as an associate or as an investment, depending how much they keep.
Correct.
And the fourth process is that the money. So it's about the fair value of it talks about the fair value.
Exactly.
So
that's right.
That you will get the money, the goodwill. So you will fair value of the rest of the share will be calculated plus the goodwill. Will be and will be offset against the.
Because you are selling the goodwill, you are selling the assets, and you get money, 50% money, and you get the value for 10% of the shares.
10% of shares plus you get the goodwill.
Exactly.
And it's all offset against the group share of the subsidiary assets. And in the end, the last part is that it's all calculated as a. The goodwill will be calculated.
No, goodwill is already calculated. Goodwill is already there.
But then there's a last part about the profit or loss statement, like what
because
about
we are disposing the goodwill and the assets, and the money what you get is the money plus the 10% shares. So you compare both those.
You think any profit or loss will be treated as a profit or loss on the disposal of subsidiary?
Because it's a pure profit or a pure loss.
Was PO plus PO? Again?
It's a pure profit or a pure loss. It's not yet. It's no longer unrealized. It's realized.
What is O? PO? What is O stands for?
PURE. What I said was I was just trying to clarify it for you. There is unrealized profit and realized profit. This is realized profit or realized loss. Because you have disposed a subsidiary.
So PUR stands for profit.
PURE. Yeah, PO. Yeah.
Pure profit.
Clean profits.
Yes, okay, I'm with you now. Yeah,
Yeah.
okay. There's a pure profit or loss. So
Yes.
yes.
It is, in other words, it is realized profit or realized loss.
Yes.
And therefore it will be treated straight in the P&L.
Fair enough. Okay.
Yeah.
Good too.
So that's basically the first part. So we will look at the second part and the third part and the fourth part of this question when we meet tomorrow.
Okay.
Yeah. We are meeting tomorrow at 6 o'clock.
Yes.
Yeah. So we'll meet at 6 o'clock and we will look at this one tomorrow.
Oh, that's fine. Yeah.
Okay. So I'll see you all tomorrow at 6 o'clock.
No problem. Thanks, Umar. Thanks very much.
Okay. Bye.
Thank you. Bye-bye.